Good afternoon, good morning, good evening, depending on your time zone. I want to thank you all for coming to our panel discussion titled The Evolving Role of the Crossover Financing Round. On the heels of the publication of Locust Walk's latest white paper, The Crossover Evolution, we're joined by a great panel of experts to help us unpack the current crossover landscape and how biopharma contemplating a crossover round can optimize the process. We have 1 hour allotted for the panel, including questions that we have prepared in advance, as well as questions received in advance from participants. If you have any questions you'd like the panelists to address, please submit them through the Q&A system at the bottom of the Zoom screen, which hopefully everyone is familiar with by now. I'll read out the most frequently asked questions and ones that have the broadest applicability to the audience at the end or woven within as relevant to keep the conversation flowing. If we do not have time to address your question, we'll certainly follow up separately with our thoughts in writing. We are recording this session and playback will be available shortly afterwards for all attendees. I am also obligated to share that due to confidentiality obligations and other regulatory requirements, we are not going to address questions specific to any one company. This is also not considered legal advice for Bill Hicks or the offer to buy or sell any security for Dan and me. Everything discussed is considered off the record. So I'm going to set the stage for the panel, give a brief summary of some of the conclusions from the white paper. I'll introduce the panelists and then we'll get rolling. So the COVID pandemic in 2019 and subsequent vaccine victory was obviously the biggest biopharma news story of 2020. It may be hard to remember, but in March of last year, the biotech indices nosedived, and then realizing what was going on, it was a temporary setback, and then it proceeded to set record-setting performance for the balance of the year, which led to a bull market, record highs, unprecedented fundraising. Crossover financing rounds and the subsequent IPOs were a leading trend in that recovery. More recently, however, and we will talk about this, the market has gotten a little bit choppier, but despite the recent turbulence, we decided to investigate further what were meaningful makings of a crossover, a successful crossover, to predict success in the IPO and the aftermarket. A few interesting takeaways from the data. Crossovers used to be about 50% of all IPOs the middle of last decade, and in 2020, there were about 83% of all IPOs had a crossover, which really showcases the importance of the crossover to a successful IPO. Companies in discovery through phase 1 of development at the time of the crossover performed better than companies phase 2 through approval, perhaps suggesting a negative selection bias for companies that waited. Again, that didn't used to be the case, but that was certainly what we found in the most recent market. 6 or more crossover investors was kind of the magical number. If you had 6 or more in a round, crossover round, the company performed better in the aftermarket than crossovers with less than 6 investors. While we didn't put it in the paper, we did find there was a high correlation to the more numbers of crossover investors in the round, the better the performance. Crossovers of 60 million or more outperformed crossovers of less than 60 million, which again, I'm sure you can imagine is highly correlated with the number of investors in that round. Companies with more than 12 months of cash at IPO outperform those with less than 12 months of cash. Maybe not surprising, but it does showcase the value of a crossover or a top-up round before going public. And lastly, and admittedly in a fully shameless self-serving manner, we did find companies who engaged advisors had more new investors in their crossover rounds, and that led to significantly higher IPO pre-money valuations and a higher valuation step up. Again, these are all correlations, not causality, but you can draw what you want from the data. So to conclude the summary, 3 biggest factors had the most positive impact on IPO performance, where size of the crossover, where not surprisingly bigger is better, the number of new investors in the crossover, where more is better, and hiring advisor, which we are actually not going to explore today. So with that, and to dive deeper into these trends, I want to thank the panelists who have joined this discussion, and I will introduce each of them briefly. So Heather Bahana is a principal at SR1 Capital Management, concentrating on early-stage innovative therapeutic investments. She has the best background of all of us, I just want to point out, and we're all jealous of her. She was previously at Sofinova Investments, following near a decade as an equity research analyst. Previous roles include roles as a chemist at the Astellas Research Institute and adjunct faculty at the Feinberg Northwestern School of Medicine. Welcome, Heather. Ali Bibahani is a general partner on the healthcare team at NEA, New Enterprise Associates. He specializes in investments in the biopharmaceutical, medtech, specialty pharmaceutical, and healthcare services sectors. Prior to joining NEA, Ali worked as a consultant in business development at the Medicines Company and previously held positions as a venture associate at Morgan Stanley Venture Partners and as a healthcare investment banking analyst in his early days at Lehman Brothers of fame. Dan Dubin, who is about to join, but I'll give him crap once he gets on board, but I will introduce him in the interim, is vice chairman and global co-head of investment banking at SVB Leerink and sits on the firm's executive committee. For over 20 years, Dan has advised life science companies and investors and executed numerous financing, partnership, and M&A transactions for clients. Prior to joining the firm, Dan co-founded Medicorp, a provider of insights in the commercial potential of biotherapeutics and medtech companies for healthcare companies and investors. Last and certainly not least, Bill Hicks is the co-chair of the Securities and Capital Markets practice at Mintz Levin. Bill works with biotech companies, investors, and investment banks in raising capital in creative ways, including various alternative strategies for accessing the capital markets. So I want to welcome you all, and I think we should just dive in, and we'll throw Dan into the mix when he arrives. So there's a lot of questions that came in beforehand, and I think when we originally started writing the paper, there was a much frothier market, and things have changed pretty dramatically in a relatively recent past. So I'm curious to get your take on, I'll call it the crossover market now in light of, I'll call it underperformance in 2021, which did start, call it February, but really started to gather steam in April in a negative way. And what impact do you think that'll have for the remainder of the year? So Heather, ladies first, maybe you want to take a stab at that.
Sure. I think there's a few things to think about. I think number one, just as we've seen this downturn, if you think about all that happens in a year, 2021 is still quite young. So, sitting in September, October, who knows where we'll be compared to where we are right now. But, thinking about where we are right now, I'd like to think of it in a couple ways, regardless of the choppiness in the markets, the high quality, great science companies are probably still going to be able to make their way onto the public markets. But I think that there is obviously a backlog of companies that have raised crossover rounds in the near past. And that flip time into IPO, which was accelerating at a pace that I think none of us had really ever seen before in the past year, is obviously longer and slowing down maybe to less frantic and potentially more, traditional levels. So it might mean that things take a pause a little, that the typical crossover investors might have their plates a bit full of companies that haven't reached that liquidity event of IPO. But as I said, the year is young, so I wouldn't be making predictions towards the end of it because you never know how much can change in a few months.
So I guess, do you think it's a blip or the beginnings of a longer term trend? Sorry, I'm going to put you on the spot.
I mean, look, I think without seeing a complete collapse of our financial system like we did last year, and even that we were able to come out of, I don't think that the window's going to close and everything's going to go away, right? Might there be more selectivity? Yes. But knowing how biotech is and sort of how cyclical things are, I don't think we're in for a long winter. I think we're just in for some patience and a little bit of recalibration from the frothiness that we've seen.
Cool. Thanks for humoring me. Ali, do you want to take that one? Your views on kind of the changing in the market?
Yeah, I mean, listen, I think, it's amazing, just looking back kind of to give some perspective, right? I mean, crossover rounds before 2012. There wasn't really an IPO market before 2012. And I think everyone sort of forgets how bad biotech was, before 2012. But, even to go public, like there weren't very many crossover rounds. Even if there were, like only a few companies would do them, right? So, then I think, now fast forward to the last year, I think the litmus test for most investment bankers were if you hadn't done a crossover round, you can't go public, right? Which, and if your book's not 1x covered, you can't go public, right? Which I'm not sure that was exactly the best sort of litmus test either, but that's kind of where we got to, right? In the last couple of years. And then, you just saw an acceleration of that market in the last year, right? So, it wasn't uncommon, in the last couple of years to see Series C rounds, being crossover rounds. And then 6 months ago that, you started to see more crossover financings happening at the Series B round. And then even in the last month, right, I'm meeting with a company that's raising a Series A. At the end, they're like, well, we're doing a Series A crossover round. And I have no idea what even that means, right? What is a Series A crossover, right? I mean, most of these, like, they don't have a full team, they're just getting going, and yet, they're looking to access the public market. And so, I mean, part of me says, like, and that's all a bleed through of what you saw was the, like an epic kind of year in IPOs. And so it's not it's not surprising that there's some softness in the market. Interestingly, I do think it takes about 6 to 9 months for the private market to catch up to the public market. So, right now, like, I don't think there's really a slowdown, right? I think most companies are still trying to go and raise crossover financings. They certainly are not shy about asking what valuations they're hoping to get. They're still trying to peg it off of kind of ultimately what IPOs have been getting done at from a valuation perspective and working backwards. So so not much has really changed just yet. Now, I think to answer your question directly, right, we saw softness in 2018 or early 18, we saw softness in 2015, in early 18 and late 19, right? So, but those were, that softness didn't last very long, right? And so then, you sort of saw things continue to go and then kind of go up from there. And so I think the real question, and it's just too hard to answer. We're never going to be able to answer, like, because we're in the midst of it. Is the softness really a blip, or is there really kind of outflows that are that are not just transient, but more likely not to come back, right? And it's usually the like there've been what's really driven the IPOs of 2020, right? I mean, is it normal to have pretty much every IPO trade at the high end of the range or above the range and then trade up 50%? No, right? That's not normal. What drove it was an influx of capital inflows from generalists coming into the space wanting to, get IPO-like returns and that look good. And so when that money sort of recedes, then the question is, and I agree with Heather, it's probably not going to go away because now, like, some of these public funds have raised dedicated private funds, so you don't have the denominator issue when their values on the public side go down. But it's also hard to imagine that, like, they're the ones who are feeling the pressure on the public side, and that's not going to bleed to the private side eventually if it is not just a blip.
No, that makes sense. And Bill, maybe you can act as the historian here because you probably see more flow of deals from your vantage point. How is the softness of 15, 18, 19, and now kind of compare from your view on deals getting done, concessions need to be made? How do you think about that? And maybe that's perhaps a predictor or not of the future.
I can't remember 5 weeks ago, never mind 5 years ago, but I was thinking back to the panel we did this time last year, roughly, and there was overwhelming enthusiasm, partly because the need for biotech nobody was talking about drug prices. The need for biotech was obvious, and funds looking for growth generalists were looking to biotech because other growth sectors weren't looking so good. I do wonder if, as we start to recover, do the other growth sectors start to look more interesting, and so that we don't have that effect as much. We've gotten the comment on getting rid of IP for COVID vaccines. Do we start to see any of those things that traditionally have dented our stride a little bit? And certainly, general market forces. So I don't know, what does it feel like? It feels to me like what they're saying, it's kind of a blip. I mean, what we've been going through has been an epic hysteria, and it's slowing. I'd say it's really the last month where I felt it slowing. It's clearly slowing in the sort of follow-on offering markets, which is one of the sort of the early indicators. I'd say the crossovers still seem pretty frantic a month ago. Now they seem to be kind of slowing. So right now, I think it sort of feels like a blip. I think I agree with what Heather was saying, that if the generalists start to pull out, we'll still see exciting deals. We just won't see all of them. I mean, I think the bar will be a little higher, but there's still a lot of high science, and there's an awful lot of money to pour into it. So it's hard to imagine it's just going to stop. So
I remember you telling me, Bill, that you guys were massively over capacity and didn't have enough lawyers to do all the deals. How's the capacity? And I'm trying to think about that as a barometer for where we were.
Still over capacity, but I think that's
not as bad.
I'd say I'd say it's not just us; it's across the board. I'd say we're all still still straining, but we sort of see it slowing down a little bit. So there's going to be a light at the end of the tunnel. Yeah.
So people might not fully perceive the slowdown. So they're still processing forward.
Right.
But it hasn't trickled its way back to kind of what Ollie said.
Yeah.
And I'm going to channel my inner Dan Dubin, where in the pre-call, he talked about it being more of a buyer's market than a seller's market. And I guess the curious for Ollie and Heather, since you guys sit on boards, do the C-suite teams and the boards actually believe that it's a buyer's market versus a seller's market? So, Heather, I'll go to you first, and then we'll circle back to Dan.
All right, this lady's first thing is going to get old really fast.
Oh, don't worry, I'm an equal opportunist.
I think there's yes and no. I think it depends on what stage the company's at. If they've already started to go out there and talk to folks, I think they know. If you're still just on the hypothetical, I think there's still that frenzy. If you haven't sort of gotten into the trenches yet, that it's hard to know that there's been this shift, I think, on the private side. But I think that comes with experience, and we'll see how things progress in the next couple months, I would say.
Cool. So Dan, I channeled my inner Dan Dubin and basically said that what you told us was that it's more of a buyer's market than a seller's market. So I'm curious if you can elaborate on that and share the implications of what that means for people considering doing a crossover.
Sure. And these markets are changing rapidly these days. 2 or 3 months ago, it was a seller's market, and we saw robust valuations that were driven by a very strong IPO environment, whereby it felt like it was a private company's birthright to execute a crossover at 250 to 350 million pre-raising $100 to $200 million, and then marking up that post money of the crossover to about 2x or plus to an IPO, and then watching the IPO go up 50 to 100%. And while that progression was moving forward, it was clearly a seller's market where the companies were the seller and they could dictate terms. There were times when, after an initial introductory meeting, the term sheets were being put on the table, and those were getting shopped, and the companies would have 3 to 5 term sheets, and people would compete on terms to some extent. Usually valuation might bump up somewhat, but within a week or two, the deal was done and closed, and there were a lot of disappointed investors. Fast forward to the current environment, which is still a very good biotech environment, just by relation to what we've recently witnessed, feels like it's somewhat depressed, but it's still very good and open. The scenario has changed, and now it's more of a buyer's market. We've seen some situations where term sheets were put on the table just before the XBI started declining, and the valuation was renegotiated down before the term sheet was finalized and deal was closed. Now, we're not seeing the punitive terms that some of these private investors had invented in the past. We're not seeing participate in preferreds. We're not seeing ratchets. We're not seeing all those things. Right now, we're just seeing valuation be right-sized with respect to the current IPO environment. And once the lead is put forth, there are still plenty of private participants that want to follow and engage at the renegotiated attractive terms. So the crossover investors are still open for business. The processes that we're running on the crossover side are still attracting a lot of attention. For now, it's just fine-tuning valuation.
Got it. So Ollie, any additional thoughts on kind of in the boardroom how C-suite and board members are thinking about the market and or reacting to it?
No, I think what Dan said is spot on. I mean, and he certainly is seeing a wider universe than maybe like myself or Heather, sort of see. I mean, we sort of, we see the deals that are coming looking for financing, right? And it's a finite pool, right? Because there's only 24 hours in a day to meet companies, right? And then there's the companies that we're in, right? That some are trying to do these. But I think that's right. I mean, there's, I think as we looked at what we've done at NEA in the last 12 months, I mean, every deal we've done has been a seed Series A. Now, we tell people that we do, right, invest across all stages. So whether it's a seed Series A, later stage private financings or public financings. And I think what's really pushed us to that sort of direction has just been, the valuations relative to kind of the stage of the molecules, like just get a lot that there's more of a mismatch as sort of the as the financings go forward. And so I think, there's probably is going to be some readjustment. Interestingly, it takes time though. I really do think, I'm still seeing, companies I meet, they certainly are still pushing sort of for valuation expectations that they and their boards have. And, now to Dan's point, whether that gets done or not, I think that time will tell, right? And so the longer sort of the softness goes on, then you're going to start to see, like that we're sort of in the midst of the beginning of the, what's been the last month of some softness, right? And so, it's still early on, and I think there's always hope springs eternal, and you hope that, that things are going to turn around next week. And so therefore then, then probably price doesn't equilibrate. But I think the longer the softness goes on, then, over the next, call it 6 to 9 months, you're going to start to see that adjustment happening more and more, for sure.
No, that makes sense. So I think that sets the table. I don't think it was too dour, but there's definitely some caution that I heard from the 4 different panelists. You have to be optimistic in this industry from what I know. So maybe just in the vein of optimism and imparting some wisdom for the audience to think about what are some best practices that characterize really the best crossover rounds. Are there deals that either any of you have been involved with that you want to highlight that were particularly effective, or were any kind of secrets that you can share about how to do the best possible crossover? So I don't know, Bill, I'll let you kick it off to spare Heather on this one.
I mean, I think the best thing you can always do is get a good lead, not obsess about valuation, and obsess about getting a good lead. So don't get the best valuation, get the best lead you can, and then the rest will fall into place. If you have strong support from a strong investor, it'll work. So that would be my main advice.
So basically, focus on the top accounts rather than going
Yeah.
from the start is maybe the practice.
Yeah, and I think to some extent, a lot of these statistics you can turn them upside down. If rounds that had a lot of investors and huge rounds did better, but also the hotter companies tend to draw more investors and bigger rounds, right? So whatever situation you're in, focus on getting your dance partner. Don't try to have multiple dance partners. Don't try to leverage someone. Just get a good partner and hopefully have them help you ride it out. My other thought would be, that the vantage point on this has changed over time, whether you get help from a bank. Sometimes you'll hear, oh, if you have a good syndicate, why do you need a bank to help with the crossover round? I think a lot of times people do need help. Sometimes it's because they're European, sometimes it's whatever. But that little edge of realism can really help. So if we're heading into choppy waters, I think companies should be more eager than before to hire a jungle guide with the bank to guide them through it.
Yeah, checks in the mail, Bill. Appreciate that one.
No.
So maybe Dan, if you want to react.
I meant Dan. No.
Yeah, so maybe you want to react to that, Dan, and any additional thoughts you want to offer.
Sure. And I think with respect to working with a bank on a crossover private placement, we usually leave it up to the facts and circumstances of a company.
Right.
If there's a management team that's quite adept at raising capital and has very strong relationships, we don't try to inordinately intercalate ourselves and suggest you really need us to get a deal done. They're more than capable of doing it. It's really, for those types of management teams, it's more about bandwidth and whether they have the time and whether it's the best use of their time. For teams that aren't as well connected or don't have as much experience, having a bank be involved either directly or to be involved as an advisor on the side is certainly useful, just to help level set and help the management team present the deal to its board, and also think about negotiation tactics so that they can at least maintain control of that process and provide unified leadership, make recommendations to the board, and not let people like Ali and Heather feel like the management team's lost control of the process. Because when that happens, that's a slippery slope. And then when the board starts running the crossover round, then that can be disruptive and challenging for a management team. I agree with Bill in terms of the lead is important. If you get the right lead, then that will make the rest of your job easier, because the right lead will help attract and syndicate a very strong group of investors. I think that there's any one of 10 to 15 funds that are well funded and well positioned to drive a strong syndicate. It's not just 3 or 4 or 5. There's 10 to 15, and that's a growing number that I think could be consistent. The other thing to think about is the complexion of the crossovers that one brings into the round. The goal of the crossover round is to help with additional profits. They're going to tell the story and socialize this to private and public investors down the road to be very strong reference points, but also to build momentum from an equity capital markets perspective. So the same brands that that people think are incredibly attractive to have as part of your shareholder base when you're trying to play poker with strategics, to say, we don't really need you to buy us because look at, we have Fidelity, Wellington, Capital Group, Prime Cap, all of these people, they can fund us forever. So if you don't pay our price, thanks, but no thanks, we'll continue to fund. Those are not necessarily all the folks that you want to completely populate your crossover round. Having those names is good for branding, but some of those mutual funds will not necessarily post orders day one of the roadshow in size and build momentum. You want to make sure you have a critical mass of investors that are going to put in those large orders so that the capital markets team can suggest we're at least 100 times covered or 200 times covered based off of existing investor demand to build that momentum and to drive new investors into the book, particularly in this environment.
So what I just heard you say is not all, even name brand crossovers are created equal from a investor perspective.
That's correct. There are some crossover investors that are very management team and board friendly. So when the management team and the board have decided to go public, they say, we invested in you to make those decisions and we're there. We're in for $40, $50 million. We have some valuation sensitivity, but we're going to largely leave that to you and the banks to figure out. There are others that will be upset that you're looking to approach the market in a tough market and say, I'm not sure I'm in. And then once the management team's worked hard and struggled to build momentum, they of course want a large order and a full fill, and they cram down all the people that came in early and supported you. So even not all the healthcare dedicated funds are created equally. And over a beer and offline, if anyone has questions.
I say we'll have a separate conversation about that in a super secret, pinky swear situation. But yeah,
we can
tell you about that.
Names.
Right, and then not all the mutual funds are created equal. I think just to pick out some names, Janus has a fund that's dedicated to doing crossover investing. So they can put in that order and they can tell you during the test of waters process that they're going to be coming in, and they'll give you a sense of what that size is, and they'll come in day one. Many of the other mutual funds, not all of them, Eventide is another one that's also very transparent, long only, high quality fund. They will come in early and support it. Now, I'm not saying that funds like Fidelity and Wellington and BlackRock, Franklin are not worthy investors. They are. You should definitively include them, but don't have too many of them because their trading desks will come in on the fourth day of the roadshow. It has nothing to do with the portfolio managers and their desire to want to support you. It's just their policy and how they treat their shareholders as a fiduciary. So just be mindful, have the right mix that it can be nimble along with you and can build that support out of the gates.
Very interesting. I'll go maybe to you next, Ali, if you have any secret sauce or tips from crossovers, maybe that you haven't necessarily invested in, but companies you've worked on or be on the board of that have been successful.
Yeah, I mean, I've just been taking notes as Bill and Dan have spoken. I wish I did. I mean, honestly, it's sort of interesting, and it always fascinates me, like some of these, crossover financings just catch fire, right? Sometimes, obviously having a lead helps like coalesce people, right? Because they're not going to make a decision until there's a decision to they have to make a decision, right? And so that's why I think, you know, I do agree, like having a lead term sheet helps. But honestly, like in a lot of these companies we've looked at, and the ones that catch fire, I sometimes, you know, we did a lot of work and we passed, and it's sort of interesting to me that like some of them catch fire, and then like there are other ones that don't, right? And I don't know, I always feel like it's sort of pulling teeth, right, to try and get like people, you know, to put in a term sheet. So, you know, I don't think I have anything kind of meaningful to add. You know, it's certainly my experience, and maybe it's just the companies that I invest in, like it always feels hard, right? Whether it's been in a great time or a hard time. So, you know, I don't know if I'm probably not the best barometer of that, but it, you know, there some of these rounds do catch fire really quickly, and it's not, you know, in trying to understand why, it's not totally, you know, very clear to me, you know, why some do and some don't, but interesting to see.
Cool. And Heather, you don't have to comment if you don't have anything to add, but happy to give you a shot if you want.
Yeah, I mean, don't have much to add because these guys are the ones who sort of know things, and we're more sort of spectators. But it is interesting when you think about a crossover round and what are you solving for? You know, it's not just solving for capital in the bank, with all the things that Dan's saying and all these things to think about. You know, it's kind of, I feel like, and it might just be because I've gotten more involved, it might not be true that it's gotten more complicated. Maybe it's always been this way, but I feel like a little bit of this engineering from crossover to IPO, you know, what you're actually solving for is a bit more complicated than just making sure you have the capital to move forward. So just something to, you know, food for thought from what I'm hearing from the rest of these guys.
So I'll throw one back at you then, Heather, that I think you can be helpful with relative to, there's a lot of companies raising capital. There's a lot of noise. You know, to Ali's point, you know, some catch fire, some don't. What advice would you give to a company about how to stand out in volatile markets when there's just a lot of competition?
You know, it's tough because the things I'm going to say don't necessarily correlate with being that deal that ends up on fire, right? Because it does seem a little bit of a mystery. I agree with Ali 100% on that, of why some things catch and some things don't. But I think, you know, some of it is when you're thinking about even finding that lead, some of it's relationship, some of it is, you know, have you met with these people before? Have you done things when you weren't raising money? Have you know, how's your storytelling? Are you ready for the crossover investors kind of to listen? It's a different sort of phenotype than the investors that you might have been with from the seed series A, where you're kind of putting stuff together and sort of, you know, flying the plane while you're building it. So I think being able to show that you have a plan and a vision and that you've been able to execute, and being able to communicate that, I think is important. For some of it, you know, there is a ton of noise, right? Especially in spaces where there's companies every week that are the same. It's like, what makes you different? And I think just kind of understanding that vision, plan, and execution, and being able to communicate it, which is key for that. That's a start from
Cool.
the company.
I'll bounce it back to you.
Yeah, I mean, maybe to add to what Heather said, I mean, I think it really, I mean, a lot of it sometimes just depends on the space, right? I mean, I think, you know, 4 or 5 years ago, you said IO and every pharma, every investor was jumping at it. Today, you know, it's not that that's fallen out of favor, but it's a lot harder, right? I mean, today, if you say precision oncology, like there are people going crazy for it, right? But, you know, like that, and that'll change, right? I mean, 3 years ago it was CAR Ts, today it's NK cells. So I think some of it is just space. But, you know, I'd say, and that can be good or bad. I mean, to me, that a lot of it comes down to that, right? What space are you in? I mean, obviously data is great, but most of these companies are 2 to 3 years away from the clinic. You know, like the data is hard to interpret. So it's really kind of, you know, the story and the space can help. I mean, obviously one of the others is, you know, if you've had a team that sort of made money for public investors before, I mean, it almost doesn't matter what they're working on. They're going to get people throwing money at them, right? So whether you're, you know, Ari Beldegrin or a Fahim or, you know, like, obviously, you know, they have to be working on something interesting, but like, I do feel like, you know, that sort of phenotype sort of, you know, there's a lot more capital flowing to folks like that. But, you know, the other thing, as I've sort of learned, like these crossovers that catch fire, you know, the IPOs will be financially engineered. They'll have a high valuation. Is that valuation really real? Probably not, right? It's a financially engineered valuation. And oftentimes, the real valuation gets set when you play through some sort of clinical data card, right? And that can take some while. It take a while for some of these companies that are, very early preclinical, but that's really where the real value gets set. And then it just depends, like where they right. And one of the things I've sort of noticed is just being having a hot crossover that catches fire, like that doesn't guarantee anything, right? Doesn't certainly may help you get the financially engineered IPO outcome that you want, but ultimately, like those companies, like there've been plenty, as we've seen over the last 8 years, that they were the hot company and they stumbled, right? The data didn't play out or they didn't execute. And so, it's all perception, right? And that's all, a lot of this is just perception, perceived value, and but perceived value can change, right, really quickly. And some of it's data driven, some of it's misexecution, and some of it can be just, spaces not sort of panning out, right? IDO, I mean, no one's going after IDO. That was like a really hot target, 3-4 years ago until the Insight blow up.
So what I just heard you say is that you have to be right 3 to 4 years from now as to what space is going to be hot, or you have to make a lot of money for someone else, in which case you'll get financed.
Or you got to just be lucky, right? But yes, I mean, that's a lot of what we do on the venture side. I mean, the stuff that I'm doing on the seed series A, like, I mean, we like the company, we like the technology, we think it could be impactful, hopefully in a clinical trial that we haven't designed, that won't be designed for another 5 to 7 years, then hopefully that'll be positive. But, for us, like, we're not momentum investors, right? So the idea of us, like, doing a crossover, having it go public, lockups come off, we get out of it. Like, that's not, we own usually too much of the company. The volumes are usually too low. And so guess what? Like, we got to be right. We got to play through that data card. And that is forecasting, from where we are, especially as things get earlier and earlier, even gets harder and harder to do.
So I'll pass it to Dan, then I'll hit Bill with a different question. But so Dan, what are some of the ways to stand above the noise and get traction or attraction for a company?
I agree with what Heather and Ali said, particularly those Pied Pipers that have made money for people before, where the crossover is really a capital call and they don't have to work that hard. They've made them so much money, they're just asking for a small fraction of that back to fund the next venture. And sometimes those work out well and sometimes those don't work out so well. But there's an obligation. They're part of the club, and those tend to catch fire. Those tend to take off at higher valuations. And I think Ali raised a good point. Some of these crossover investors that are adept at playing the public markets, when they see a certain pattern, they'll play the momentum. They can buy into the crossover round at a good valuation, see that get marked up, buy more shares on the IPO, even trade out of the IPO shares, make money on that, whereby that's not how NEA, as I understand, does it. So these guys have a trading dynamic that allows them to lock in a return, whether or not it works long term. It doesn't mean that when they're making the investment, they don't have a long-term intent. But if things change, they have more nimble trading strategies, so they can lock in gains and profits and still do well. So not all the participants have the same structure, incentives, and necessarily durability. When markets become tougher. The other thing with respect to rising above the noise long term is, and I think this goes back to the original statement, is don't seek to optimize valuation and base valuation on a momentum market. Build the strongest set of investors, be as transparent as possible, have fantastic communication, set expectations clearly, strong communication and linear, even if it's a steep slope, progression of value and achievement of milestones over time is the best way to achieve success long term and avoid the extreme volatility, which can be very disruptive to either a private or public company with respect to employee retention and other dynamics.
Cool. So Bill, I'm going to pivot over to you and give you a layup based on your background. So in the case of a private company looking to go public, if the crossover route closes off to them, which will happen to some of the companies in market now, they just don't know it yet. What do you do next? What's plan B? What does that look like? How do you think about alternatives to the traditional routes?
It's tough because and by the way, that's been going on even during the boom. There's been the people that the haves and the have-nots, and there've been plenty of companies that have been struggling. And it's tough because the crossovers more and more of the early investors are now the crossovers who keep crossing further and further over. A lot of the alternative type of transactions you like to do, they really do much, whether it's a SPAC or a reverse merger, they do a lot better if you can do a concurrent pipe with, guess who? Those crossover investors. So if you're struggling to get into that group, I think it's just tough. You got to work hard and try to find, other sources, family offices or what have you. But there are some, the SPACs and the reverse mergers can be helpful. The NASDAQ company that the phase 2 study fails and they got $50 million and they basically sell their listing and their cash. That can be a route. We've seen deals where company didn't have enough backing to do a $90 million IPO, but they were able to stitch together 40 million from the shell, 20 million from a new investor, and 30 million from insiders. So I think, and SPACs can be a similar dynamic. They have cash, but you don't know if it's going to be there. But if you can put together some inside investments, you get some of the trust to stay. So I think you got to roll up your sleeves and do the work. And it's not going to roll out as smoothly as if you're a hot crossover. But if you act quickly and you act decisively, you may be able to stitch together pieces of different pockets to get a deal done and live to fight another day.
So I guess maybe then just to pivot to SPACs, since you brought it up, and there was a bunch of questions from the audience about that. Is SPAC a viable path? What are your views on SPACs? And then I'll go to Dan on this. I'm sure he also has an opinion.
And not all SPACs are the same. There are SPACs that have loaded up with crossover investors looking for a deal to do. That's very sweet, and that can do very hot deals. Because you're basically doing your crossover round and going public with the same people you might have done a crossover round with anyway. So that's the highest end SPAC. Other SPACs that are loaded up with investors that aren't necessarily healthcare investors in a choppy market, I think there's more uncertainty as to whether those guys will redeem or not. And so, again, you got to roll up your sleeves. But I think they can be a useful mechanism where there is some cash. There are also a lot of investors that will invest in something if it's liquid that don't want to invest in something if it's not liquid. SPACs and reverse mergers are sort of in between, because if they're going to invest in the pipe portion of it, they're going to be liquid for 4 months. So if it's a choppy market with uncertainty, that part might be more challenging. Having said that, if you can get the SPAC done or get a reverse merger done, and you are a public, then you can raise money. And I've seen that many times where, a reverse merger where they were hoping to combine 30 million from the fallen angel and a big pipe. They don't get the pipe done. They close anyway. Once they're public, they're able to raise the money. So again, a lot of it is not letting your fantasy deal get in the way of your available deal and finding that crease, getting the deal done that you can get done. So I think SPACs and reverse mergers both play an important role. It's just not formulaic. You can't just say, if you do this, it'll work. You just got to kind of fight it out.
Dan, anything you want to add to that? I'm sure you have some insights into the current SPAC market.
Sure. I think as you take a look at some of the SPACs that have been raised, particularly the warrantless SPACs that have a high proportion of fundamental investors as shareholders, 70% plus, that was clearly a function of the market being rewarding. And that was quite distinct from how SPACs were raised just 2-3 years ago. And as you look at those, as Bill was suggesting, not all SPACs are created equal. Those are high quality SPACs. Those are IPO ready syndicates that one could plop those shareholders into any private company and be really proud to announce that they've executed a high quality go public strategy. So those are highly coveted situations. And we've seen some deals that have been announced and closed with those types of funds. And some of the performance has been good and some of it has not been as good. So the results are somewhat mixed. As a consequence of that, given that these returns have not jumped through the roof, and more recently, some of those have even pulled back, so many of them are not performing exceptionally well. We have seen some hesitancy on the SPAC pipe market, and the pipe buyers are concerned about the illiquidity that they incur with respect to a commitment they make 3 to 4 months before a deal closes, and then having to think about an additional 2 to 4 months of illiquidity because they have to wait for the shares to get registered. If Bill has advised someone to do it through a resale S1, we can talk about whether you can do it through the S4. And then even once they're registered, the transfer agents are so busy in this market, it can take an additional month or two, even once they're registered, to have the legend removed so investors can trade them. And these investors are sensitive to that because while they're illiquid, they're marked down in their books and it impairs their performance. So that's happening. Now, all of those tactical things become less concerning when the market's hot. When the market's cooler, then the pipe buyers are going to be looking for different elements. They're going to be looking for ways to get the shares registered sooner. They're going to be looking for ways to remove the preclusion to be able to short the SPAC shares during that period of illiquidity, because they don't want to be 2 to 4 months behind all of the other SPAC shareholders that can trade the shares sooner. And they'll also be thinking even about the value of the deal. There are deals that are going up being marketed at a certain value, and they end up being revalued by the pipe investor. Said, well, I don't like it at that price, but if all the parties want to consider something a lower value, we'll consider it. And not just getting revalued in terms of target value. There are some pipes where the pipe buyers are saying, I don't just want to revalue the target. I want to do the pipe at $8, not $10. Because at the end of the day, when this closes, I'm not so sure that the SPAC deal is going to hold $10. It might go to $8, and I need some incentive for that to take on that liquidity. But these are all economic factors that will get put into play. The other thing to be cognizant of in a tougher market is what happens with respect to the cash and trust. And depending on the proportion of fundamental investors you have, if there are fewer, then you question about whether that cash is going to be delivered and how much effort and marketing you have to do to convince some of those SPAC buyers that aren't inclined to want to stay in long term to sell those shares to someone that is inclined. So it's extra work. It's all doable, but there are ways to try to align incentives to with the SPAC sponsor to align them to have them really be motivated to keep as much cash and trust as possible. Ultimately, these are all economic adjustments. And I think that if the market gets tough, some of these high quality SPACs are going to be very interesting vehicles for private companies to consider to go public.
So basically a return of the old reverse, but a cleaner version of it, perhaps. Is that fair?
Potentially, yes.
Yep. And that all these dynamics of the pipes and being locked up, it's the same. You see the exact same things with the reverse mergers when they're prevalent. It's exactly the same dynamics.
Cool. So Heather, I don't know if SR1 has a view on SPACs, and I've had conversations with some of your colleagues. Maybe anything you want to share about kind of your views as an investor relative to portfolio companies?
You know, we've talked to a ton of people just to try to understand it from sort of all points of view. And, you know, I think a lot of it does mirror the crossover dynamic as far as your fundamental investors that are in, and there's influence amongst them and things of that sort. So I think that they're similar. You know, I do think it's an interesting vehicle that for companies to consider. And especially, you know, one of the things I think that's been positive with the frothiness of the market and just the influx of capital is how much capital has been able to be raised from some of these companies where, you know, even if the markets are then choppy and you've got a year plus to the clinic, you know, you have the capital that you need to execute. You don't have to go back to the markets until you actually can hit, you know, a value inflection like Ali was saying. So I think to some extent, you know, if SPACs are going to become, I think they're here to stay. I think they're going to just become an alternative way to get public. And I think, you know, there's pluses and minuses. I think they're being billed at first for being just less work. I don't know if that's true. Less fees. I don't think that's true anymore, you know, because that didn't last very long. That lasted like 3 weeks, right? But sort of you get your crossover and IPO sort of done at once, but very similar dynamics. But I'd say, you know, I think it's all companies should really be looking at both. But I think with those fundamental high quality SPACs, there's a lot of overlap between the crossover investors and these pipe investors. So you're kind of hitting that at the same time. Whereas like for people like us, we're less in the SPAC game because we're also a little bit less in the crossover game. It's something we look at, but you know, we haven't really taken a jump in at this point.
But you're the decision maker, right? If you're in the A you're the board member who's going to decide which route you go and what you want to do. You'll have more authority at that point.
Yeah, no, fair enough. But I think it also comes down to what makes sense for the company. What's the management team like? Are they built ready to jump into the public markets yet or not? Can the SPAC offer something that might be useful as far as people or things like that? Or is it just purely financial, purely economic? I think there's nuances there that sort of run the gamut and will matter sort of company by company, I think.
Yeah, oh, that's awesome. So Ali, I'm going to turn the next question to you. And I always like to ask about the underdog, folks who are not backed by the marquee top tier venture creation backed companies. If someone has something interesting and it's family office backed, what is some things that they could think about to kind of do the crossing the chasm from being either non-institutional or kind of second or third tier institutional back to getting somebody like an NEA or an SR1 or some other top tier investor to commit? And any suggestions or feedback, I'm sure will be appreciated.
Yeah, I mean, listen, I think there are great companies that are venture backed. There are plenty of great companies that aren't venture backed or backed in a, maybe in a traditional way. I think that, my sense is that those companies have been running kind of the same playbook as the venture backed companies, right? They'll often go to like a Dan or, and try and I'd say, they're, probably having an agent probably does help, right? Or go to Locust Walk to help them through that process, because it's probably not one that their board or the team is as familiar with. And so I think there's, the similar kind of path that venture backed companies have taken. I think for, non-traditional backed companies, they're going down that same pathway, right? Trying to get a crossover round done. Now, I think there's some challenges that can come that make it harder to get some of those deals done. Not impossible, but harder, right? And usually I think it's partly valuation, right? Can be a big sticking point, because the valuation step ups and as from the non-traditional can sometimes be a lot greater than what you see on the venture back side. And so that can, if the crossover funds sort of perceive that as maybe too far to bridge to an IPO, that can sort of be an issue, right? Sometimes the voting control can be an issue, but like I think those things are all surmountable, and it just depends, does that company really want to go public? And if so, like they probably do need to go through that process of at least getting some more traditional institutional investors that can help and help get an IPO done. And again, that's where I think having a bank to help can probably be the path of least resistance for them in terms of getting to the right people and helping the board through that process.
So before I turn that to Dan and Bill, would you view that similarly for a European-based biotech? And I don't mean to lump an entire continent together, but there were a few questions about that as to not just how to get above the noise, but how to make that jump, not just from non-institutional to institutional, but from one side of the Atlantic to the other. I'm curious if you have any views there.
It depends on my thought, it depends on the European company. There's some European companies that already have sophisticated, well-connected boards and investors that can connect them just like any other company could. There are others that really have no idea of what's going on out there, who they should talk to, how they should talk to them. So my bias is with those companies, they should, but it just depends. The American funds are out prospecting there now. So it's, the odds of a gem that hasn't been discovered, showing up are probably lower than it was before. But I think it just depends. If they're not connected or don't understand the process, they should. If they've got well-known U.S. investors already invested, they probably don't need it as much.
Yeah, Dan, any thoughts on kind of the underdog or the European? I'm sorry to lump them together, but just curious how you view them.
Sure. I appreciate that. There's some great technologies being developed across the pond and some really smart and talented entrepreneurs. I think that the time where they can use help is that as they're thinking about the task of raising this next round, they think about it quite deliberately, structure a time frame around it, think about everything they're going to do to get it done, and then start marching through it. And it's a nonlinear process. It's all about networking, relationship building, referenceability, because you're asking sophisticated investors to go from 0 to 60 in 2 to 4 weeks. And we know that when Ali and Heather typically do something, they'll know a company for 3 to 6 months, if not a year or two, following their progress and finally deciding when they might actually want to invest in that particular entrepreneur. And without referenceability, it can become hard. And we see some management teams become frustrated because they feel like they're meeting everyone. They have a good pitch book, they're telling a good story, but all the investors are saying, this is really interesting. When you get a lead, let me know. And really what you need is you need referenceability. You need a board member. You need, in some instances, a bank if they have credibility, or you need one of your investors to call up a friend and say, I've done a lot of diligence here. I've been watching these people for 3 years, and provide that comfort to get people to want to come in and put forth a lead term sheet. So it's a nonlinear element where I think that advisors can be particularly helpful.
Yeah, I'm sure that applies not just to European company, but also to non-institutionally backed companies as well, where independent boards might be very helpful to validate. But cool. So we're running out of time, so I want to give each of you a chance to have kind of any concluding thoughts about either your views on the market or optimism about the future. So to get Heather off the hook, maybe I'll start with Ali and have him get us going.
Yeah, I mean, listen, it's been an amazing 9 years in biotech. I mean, it's not lost on, and yeah, I probably would have thought that 3 or 4 years ago the party would have ended, and I was wrong, right? So I mean, it's just been incredible, and say the innovation, being able to fund the innovation, being able to drive things faster, more programs. I think that's been great. It'll be interesting to see kind of what happens from here, right? We're sort of in the midst of the softness, so. Is this going to be like the end of 2019 or early 2018? And, like we'll sort of, that it'll be transient and things will at least sort of, become more open or not. And I think that, we're just sort of a little bit hard to tell, but I think we'll all sort of see in the next couple months.
Cool. Bill, you want to go next?
Sure. I have a feeling this will end up being a pretty good year by the time we're done. How it'll play out, who knows? I'm a little worried. The years where it's really bad is where people just don't know where the knives are going to fall. No, people will do a deal at any price. They don't want to do a deal and find out that they did it at, they overpaid by 2x a month later. So I think, great uncertainty is the biggest concern. And there's enough macro factors that could cause that. So that's what I'm most worried about. But I have a feeling we'll end up kind of slogging through the year, and we'll have some good times and some bad times.
Cool. Dan, do you want to go next?
Sure. But I think I agree with respect to the macro factors and I do think with respect to the falling knives, the question of whether they're known and anticipated or not, I think people understand the wall of worry that the market needs to climb. I think it's still going to be challenging for monetary policy to change meaningfully with respect to interest rates, reinflating the economy too rapidly for a whole host of reasons. There might be little nudges here and there. There might be little wisps of a reopened inflation burst. But is that really going to be sustainable? Probably not. So as long as the long-term trend on interest rates remain low, even if a little bit higher from all historic lows, I think we'll still be fine. And ultimately, once all the hand-wringing about the macro factors goes away, the growth areas of the economy, biotech and technology should take off. The fundamentals have never been stronger. The innovation's incredible. The convergence between technology and biotech we're in the midst of it. It's real. It's not a dream anymore. And the fund complex, the company builders, like Ali and Heather, and venture capital groups, as well as these crossover funds, have tens, if not hundreds of billions of dollars to support these companies, much longer than they did 20 years ago. So when the setbacks, well, not everyone might appreciate the price where everyone wants to support them. The money's there. It's not like the money has to be found. The capitalization's strong. And I think that overall, the infrastructure that's in place, management teams that are on their third or fourth or fifth company that have learned from their mistakes and aren't going to make the mistakes that they might have made 10, 20 years ago. The regulatory policy, which is in general favorable with respect to growth. Could something happen with drug pricing? Possibly. Does the government really want to destroy the one true industry that is really leading the way and differentiating the United States from the rest of the world? Hopefully not, and probably not. So I think the fundamentals are strong. I think this year that price is going to find volume. will rekindle the returns that have driven people into this space historically on new issuance, and we'll be back at it. Whether it's 1, 3, 6, 9 months, I don't know. My crystal ball is not that good. But these companies are too good not to be funded, and there's too much progress occurring for investors not to continue to be excited in the space.
Cool. Heather, any concluding thoughts?
The quick one, going back to Dan and the nonlinear path and all the fundamentals that Ali was talking about, it's a really exciting time. And if you're trying to raise and if you're struggling a bit, just keep in mind those relationships and the people that you're interacting with and the feedback that you're getting. These things can catalyze in crazy ways that you don't even know. So I would say just, chin up, and the macro factors are what they are, but fundamentally we've got something really amazing going on in our industry. So, I think everyone will find hope as long as they keep themselves open to sort of outlier interactions and data that may then feed back in a non-linear fashion and maybe help you get to the next level.
Awesome. Well, guys, I really appreciate all of you joining. We're out of time, unfortunately. We can go on for hours, I'm sure. But as a reminder, if you missed it or you want to get a part of it, watch it again, there'll be a link to the recording, which will be sent out via email to each participant. If you want to read more about getting the most out of your crossover, we put together the white paper. Just go to the website and you can download it, the Locust Walk website. We look forward to seeing you all in person, hopefully very soon. And in the interim, please get vaccinated if you haven't already, and continue to do the great work that our industry does. So thanks, and have a great day.